Hey, it's Michael Vrlaku here. I've spent over 20 years in the mortgage world helping thousands of buyers and homeowners get into the homes and the loans that they want, even when others said it couldn't be done. And there's one thing that I've learned, it's that credit can make or break a deal. And it could also mean the difference of paying thousands in additional interest to lenders because of less than perfect credit. That's why I'm excited for today's guest. Paul Oster, known nationwide as the nation's credit repairman, is featured on CBS, NBC, Fox Business, and Wall Street Journal regularly, to name a few. He's joining us for a very special podcast dedicated entirely to credit. You know, how it works, the hidden traps most people don't see coming, and the proven strategies to put you in the best position possible. Even if you think you already know credit, I promise you'll walk away with insights you've never heard before. And if you're considering mortgage financing anytime soon, whether you have credit concerns or simply want to lock in that absolute best rate that's reserved for top-tier profiles, then this episode is a must-watch. And here's what we're going to cover: the real truth about credit scores and why the number isn't the full story, the everyday mistakes that quietly tank your credit and how to avoid them, and insider moves that can save you thousands in interest and get you approved faster, plus how to position yourself for the best possible rates in any market. All right, so let's just jump in, and by the end, you'll see credit in a whole new way you've never seen before.
Two different topics right now are the hot topics: student loans and the Prime membership phishing, vishing scam thing that's going on. I don't know if you've heard of that.
No, it's Prime, like Amazon Prime?
Yeah. So there's like, I don't know, 115 million Prime members in the United States alone.
Right.
So the scammers, if they send out 100 phishing emails or 100 smishing texts, they're going to land on a Prime member.
Yeah.
So the text message is, "Hey, Mike, this is Amazon reaching out to let you know there was a problem processing your payment for one of your Prime purchases, blah, blah, blah."
Yeah.
And they're either just trying to redirect them to a website or that they click on, it has viruses and malware, or they're trying to get them to put their payment information in.
Right.
And they just process a payment for something different.
I would imagine it's a funnel in a sense, and it pulls you in as far as you want to go.
Exactly.
Right.
And part of the problem is they already have some of the pieces of the puzzle from previous data breaches.
Right.
So they'll say confirming, your name, your address, your telephone number, your email. So you're like, oh, it must be legit Amazon. They have all my stuff, but they're missing a couple of pieces, and that's what they're fishing for.
Yeah, it's really scary. I mean, I get it all the time. I'm close to, clicking on things.
It can happen in a heartbeat.
Get tempted, I appreciate you joining me. For those who will be, viewing this later, I'm Mike Vrlaku. I'm a mortgage professional with over 20 years experience here. One thing that I'll do that's a little bit different maybe for you, Paul, is that I specialize in FSBO transactions. So a lot of my audience will be sellers and, of course, home buyers. And sometimes that comes together because for sellers, not only am I, there supporting them and helping them connect and find buyers, but then it's offering the creative financing options that will get more buyers to qualify for these properties. And so as we know, credit is a huge factor in obtaining mortgage financing, and that can go for sellers that are looking for financing options to stay in their home, improve their home, to prepare it for sale, or again, just working with a financial professional who can, have creative ways to, get the buyers. And sometimes they're renters to buy, and a lot of the rent to own buyers out there are, people who are working on their credit. So, I'm thrilled to have you join, Paul. I had some points here, nation's credit repairman, over 25 years experience in, this industry, obviously a trusted voice in credit repair. Maybe you could just tell us a little bit about your journey here and, so hot topic.
Sure. So I started Better Qualified about 20 years ago with my partner, Eric Sturkin. We were both in the mortgage industry back in, the day, as they say, when subprime mortgages were all the rage. So every single credit report that we looked at was very, very colorful. So in helping a couple of those borrowers, instead of just slamming them into a high interest rate mortgage, I actually tried to take the time to do a little bit of legwork on their credit before we closed the deal. And we saved borrowers a ton of money. And as a matter of fact, one borrower in particular came back to my office with a bottle of scotch. And he said, Paul, I can't thank you enough. We got him a 1 point better interest rate on a $400,000 mortgage. So it was substantial and saved him a ton of money. So he said, I hope you like scotch. And I said, I love scotch. So you nailed it. And as he was walking out, he said, you'd probably make a pretty good living just helping people with their credit. And that was the aha moment for me. I literally gave my 2 weeks notice the same day. I did a little bit of due diligence on starting a credit repair organization in the state of New Jersey. And 20 years later, fortunately, we've grown organically. We're almost 100% referral based, with partnering up with, lenders like yourself, financial professionals, real estate agents, financial planners, CPAs, all over the country. So it's been a great journey. Unfortunately, the credit reporting industry is a disaster. It really is flawed at best. When you look at how impactful credit scores are to the average consumer, and the fact that most consumers and a lot of real estate professionals don't even truly understand how this whole thing works. I was just looking this morning, doing a little, professional development myself, just to see where we are with this new FICO 10 suite scoring model. Okay. Again, most people don't understand. Right now, there's 16 active FICO scoring models, 16 different scoring models, and that's without getting industry specific.
That's without industry specific or purpose specific, or that's one.
Yeah. So if you go to buy a car, you could have a very different TransUnion, Equifax, and Experian score than if somebody pulled a mortgage report with you. If you go to get a credit card, so those scoring models are weighted differently, industry specific. And then you throw in the fact that there's 16 different active FICO scoring models. As a certified FICO pro, believe it or not, I'm the first person to tell everybody, don't worry about the damn scores, because they're going to change depending upon what scoring model the specific creditor you're applying with. Mike, you could go to 3 different banks on the same day to apply for a mortgage and have 3 different TransUnion, Equifax, and Experian scores, because those lenders might be using different score models. The most widely used scoring model in mortgages right now is FICO 04. That was released in 2004. It's over 20 years old. But banks hate change. So even with this introduction, and the press always makes a big deal about it, whatever current administration, the FICO is releasing a new scoring model that's going to help the underbanked and the underserved. And, well, the problem with that is banks have the option to use whatever scoring model they want. And again, they have 20 years of history. They know the exact predictability and default rate on the FICO 04. So they say, why would I change? I'll use the same scoring model.
Most consumers don't realize just what banks have to do, how they risk factor, and then, how they bundle and invest. And all those things contribute into making a change that could affect risk. So, you said something that's really important. So my journey, I was at big banks. I was at Bank of America, then PNC, and we're using one system. It is, that's it. If the program calls for 3 credit scores, those are the 3 credit scores. That's the scoring system we're going to use. And there's no flexibility. There's no options. Now I am a broker, as you know, and I have over 40 lenders that I go to. And so, you look at that, one of my jobs now is that when we're looking at a credit assessment, some buyers might have a higher Equifax versus TransUnion. And it could be, like a home equity, for example. I had a customer last week that had one score that was just 50 points higher than the other, and they were declined by actually, their bank for home equity, but they were using a different scoring model, different, report than I was able to. So we used the higher of and got it done. So, as you said, don't worry about the credit score so much. It's what goes into, those scoring models, right? So maybe you can break it down. What really are the contributing factors of credit score from a basic, fundamental level?
Yep. So there are no one knows the exact formula and algorithm that FICO uses to generate these scores. It's a more closely guarded recipe than Coca-Cola, but they do give us score factors. The number one factor, and it makes sense, is payment history, right? You pay all your bills on time, you're going to have a higher score than somebody who doesn't pay their bills on time. The problem is most consumers don't realize how devastating a 1 times 30-day late payment. Let's remember, 30-day late payments get reported or can get reported to the credit bureaus if you fail to make your payment before the next due date or 30 days after the due date. It gets reported, easily drop your score 20, 50 points, maybe more if you're a young, thin credit profile borrower. If you go 60 days late, it's even more devastating. 90 days late, even worse. Typically, if you go 120 days past due, you're going to go into collections. So I tell everybody, put all of your payments on auto pay. I would rather get a $20, $30 overdraft fee than get a 30-day late payment on my credit report, because that late payment is then going to cost me more money for every other financial transaction. So payment history is number one. Number two is your utilization ratio. A lot of people don't understand. Income is not a factor in our credit scores. It has nothing to do with your credit. What FICO knows is how much credit you have available and how much credit you're using. The magic number here is 30%. You need to keep all of your balances less than 30% of your credit limits.
And Paul,
go ahead.
When we talk about credit utilization, I think there's something that's very common, and it's a misconception as to when that statement comes, I pay it, right? And it's like, okay, so you do pay it off. Maybe you don't hold a balance month to month, but where the credit card is reporting to the agencies, it could be in the middle of the month. It could be that day that you had that highest balance, right? So that $5,000 limit, you charge $4,500 that day, and it reported that day. All of a sudden, your utilization's very high, even if you're paying it at the end of the month.
Yeah. So fortunately for us, one of the best things we did was we moved into, and this is before AI became all the craze also, but our credit reporting agency actually has some artificial intelligence built into it for exactly what you're talking about. It's called pay down dates, because all creditors report to the bureaus at different times during billing cycles. Yeah. So some people are paying off their credit cards in full every month, but if you look at their credit report, it looks like they're carrying balances because of when they're paying those balances down. So there is a way that you can figure out what's the best pay down date, because that you're going to pay it down before the creditor reports to the credit bureaus. That's how you're going to maximize the amount of points that you can get in an increase by making the payments during that time. Now, listen.
I got to think, if we just asked 100 people, how many of them understand the pay down dates of their credit, cards? I would imagine if there's one, I'd be surprised.
We speak to 100 people a day. Nobody is aware that happens. Most people don't understand about micropayments. So not only paying down the credit card in a pay down date, people should be making if you're carrying any credit card balance at all, your number one goal should be to get rid of that credit card balance. Most people are in the high 20 percentile range for APRs on your credit card. So if you're carrying balances on your credit cards, and you decide to eliminate your credit card debt, and you're going to take an extra $100 a month and put it towards your credit card debt, the best way to do that is to stack the debt, put all your credit cards in order. The credit card or cards with the highest interest rate come first. You take the full $100 and apply it towards one card. Sometimes people make mistakes and they pay an extra 25 here, an extra 25 there, an extra 20. It feels good because you're paying down 4 different cards, but mathematically speaking, pay it towards one card, make the minimum payments on all the other cards. But instead of making one payment of $100, make 2 payments of $50, make 3 payments of $33, whatever it is. Because this has nothing to do with your credit, but this has to do with saving money. Credit cards are built on daily compounding interest, which means your balance is going to increase every single day during the billing cycle without spending another dime, because it's calculated on yesterday's balance that accrued interest.
Right.
So today's balance is higher than yesterday's. So if you made a $50 payment today, when they recalculate your daily compounding interest tomorrow, it's minus $50. And if that holds true throughout the billing cycle, you're going to save yourself a ton of money, just paying the same amount of money just by making micro payments.
Yeah, and so like you bring that down, right? So you said an APR of over 20%, but we just talked about 20% APR. It's a big number. And so for anybody who watches this, who holds balances, right, just to repeat that point, is that it's an interest rate that's charged daily. So if you can set up multiple payments in a month, if you could afford $400 or $500, whatever it is, and you break that up into 4 payments or 2 payments, depending on maybe when you have that cash flow, you save a lot of money on interest. And a lot of people don't realize, when you think about, I always thought about, paying interest in the same way as earning interest. So, if you can go to a bank and they were going to give you 20%, interest, you might be very excited about that. But at the same time, you're over there with a balance on your credit card. You got to think about it the same way. I want to put money in there, and you want to, whether it's earn it or save it, it's still 20%, and it's a big difference. So breaking up the payments, that was a great point.
I'll take you on the road with me to speak, because it's one of the things that I stress the most. There is no better return on your investment, because that's what paying down credit card debt is. It's an investment in yourself. There's no better return in any market right now where you're going to get 29% return on every penny that you invest. So if you're carrying credit card debt, but here's a thing that happens. And again, I'm not a certified financial planner, but if you just think about it for a second, it doesn't make any sense. People are putting money into a savings account that's earning them 2%, and they're carrying credit card balances. Until you are 100% debt-free from credit card debt, don't put another dime anywhere. Stop it all. Put it all towards your credit card debt. That's the greatest return in the investment. Yeah. Then you start to refund, your retirements, your savings accounts, all of that stuff. But if you're carrying credit card debt, number one thing you do, get out of credit card debt. Yeah. And the other thing is, on the utilization, Mike, it's both cumulative and individual accounts. So if you have one account that's over that 30%, 50%, 80% utilization, that's going to hurt your scores. So if you have 4 or 5 cards, they take all of the credit limits cumulatively, and they match it against the credit card balances cumulatively, but they also do it by individual card. So you have to really pay attention to keeping all of those balances.
I want to break that down real quick, but to kind of finalize that financial advice, right? So just as I said, I look at savings as, and what you said, investing in your own, your own self, right? It's where you're putting your money. Are you putting it in savings at 2%? Are you putting it into the balance at 20%? It's still putting your cash flow. And then going back to an earlier point, whereas you're looking at different credit cards, sometimes it's cash flow. So some people are going to be limited to how much they're able to pay down the debt. If you're looking at what your credit balances are, you certainly are going to pay attention to that highest APR and try to, allocate as much money towards the highest ones as possible, and also eliminating those. So if you totally eliminate one of the credit card debts, and then that monthly obligation that you have can be reallocated towards the other debts, now all of a sudden, you start advancing kind of your credit relief there as you pay that down. So
100%.
So that's great financial advice. In terms of what you just talked about with credit utilization, right? So in an example for everybody that maybe can kind of bring this home is that if you have 5 credit cards, say 4 of them are somewhat minimum, $2,000, and you barely use them, so they're somewhat low credit utilization. So now you have 4 different credit cards that are, positive attributes to your credit profile. But let's say you took out a very large credit loan at a high limit. It's $30,000 on a $30,000 limit. Now your total utilization is extremely high because that was the big one. That was, factoring in when you look at your total credit utilization, right? So do I understand that correctly? I mean, you have some positive there on some of the credit, but don't think, hey, I have 4 credit cards I barely use and I just use one. That could still be a kind of a negative scoring factor overall.
Yeah, 100%. There's a product out there called the Care Credit, and a lot of people use it for medical situations. It's huge in the dental industry, vision. So they give you the option to pay off your medical bill using Care Credit as a credit card. The problem is, if you owe the dentist $5,000, guess what your credit limit is?
Yeah, they're going $5,000. That's right.
Yeah. So you're basically maxing out a card as the day that you open it. So just be careful, again, about, you spoke about home equity lines of credit. It's a great point to let people know 2 very, very different products. Home equity lines of credit are actually tagged as a revolving account. It's like your house's credit card versus a home equity loan, which is a second mortgage. So they both have pros and cons, but people need to understand what's going to help them or hurt their credit. Specifically, a home equity line of credit typically is not the best way to go when you're concerned about someone's overall credit profile, because again, typical scenario, someone buys a home, they want to fix it up, they take out a HELOC, and they get an estimate for 80 grand to do some work. Well, we all know what happens. It comes in at 100 grand, but you go down to the bank and ask them about getting a home equity line of credit. Banks love them. They make money off them. But what happens is most people max it out, right? They make it attract, you're only going to pay on what you borrow, right? And you don't pay interest on the money if you don't take it out, which again, that makes sense. The problem is most people max out their home equity lines of credit, and until they can then pay that down, and you're not talking about a couple of $1,000s, most HELOCs, as you know, $10, $20, $50,000, it becomes a difficult situation for people to get out of. So it's a great point for you.
It just makes me think real quick, because I've had loan officers that work for me over the years, and I've had conversations in terms of setting up a home equity. So I'm a big proponent for it, but as you pointed out, there's some downsides to it, especially when it's not set up correctly. So many of the consumers out there that go to the bank are very likely setting it up incorrectly. And it starts with the questions that you ask, right? You might go to the bank and say, I need a $100,000 credit line. And the banker goes, okay, sure, let's put in the application. That's really their job. And they don't really know much more than that. And they might need close to that 100,000. So then you have the situation you just pointed out, right? A very high revolving account, and it might mess up your complete utilization issues. Whereas maybe someone comes to someone like me, and I say, okay, home equity might be the answer, but let's set it up with a much larger line. Try to be smart about it, don't use it all, but for credit purposes and maybe other financial purposes, let's set it up at 200, take out the 100 and use that as a safety, but it also helps your credit, right? That makes sense to do it, something like that.
It does. And one of the things that I've enjoyed working with you over the years now is you're very much a mortgage planner, right? So you're looking at the holistic picture of the borrower, not just taking the application, slamming in the loan, and going home at night. So mortgage planning is probably the most important part of any borrower. Unfortunately, like you said, a lot of loan officers and lenders don't do it. They're very transactional, and that winds up hurting the borrower for sure. So,
yeah, and the worst part to it over the years is that I see those that are hurt by it don't know. They just don't know. They got what they asked for, really, and they don't realize there were better solutions. So, when we talk about like credit, like a lot of consumers out there are actually, I think I read it recently, 50% of consumers are being turned down for home equities. And I think that a lot of it is just going to your bank, and the bank is strict, but a lot of it's credit as well. It's just getting your credit scores. So, anybody looking that are homeowners that might need like a home equity or financing for your home, that's certainly the credit repair part of it. But maybe you could tell us a little bit about when you've gotten yourself into trouble with credit, and you need to increase your scores. I deal with a lot of people who are in the 500s and they want to buy. And for me, I always say, we want to know everything now so we're prepared for later, right? If you're looking to buy in 6 months and you don't really know if you can buy in 6 months, well, then let's not talk in 5 months, right? Let's find out today. Let's take a couple steps. And one of them, most crucially, actually, for me, besides savings, is credit, because you might have a credit profile, which I'm sure you can explain here, that is going to need a little work. And some of that work takes some time. So maybe you can elaborate a little bit on that.
Yep. Well, first of all, what you said, again, couldn't be more, accurate, pinpoint accuracy. Knowing the options as soon as possible. One of the biggest mistakes, whether you're a for sale by owner, you're a renter, buyer, seller, is not knowing almost until it's too late, right? So you have to know what you're dealing with as soon as possible in this process. If you're a for sale by owner, the minute you start thinking about selling your house, you should be looking at your credit, because where are you going? You're going to have to buy somewhere. So you're going to need a mortgage probably. So knowing what your credit is and where it stands as soon as possible in the process is key. Here's a big problem. You have companies like Credit Karma. Most people are monitoring their credit through Credit Karma. They're terrible. I hate to throw another, business or a company under the bus, but Credit Karma can be spot on, or they could be wildly off the mark. And when you're talking about your credit and a number that's going to have a significant impact on this process, you can't hope that it's okay. So the number one thing to do is for people to contact you, a lender that has an accredited credit reporting agency. We know the information is as accurate as it can be, which, by the way, that's not even very accurate, but it's 10 times more accurate than Credit Karma, Credit Sesame, Credit this. Those are all consumer sites, and I get it. If you want to use it as a piece of the puzzle, feel free. If you're looking for financing, you have to go to a lender and get an accredited credit report from a credit reporting agency. Once you have the report, you have to go through it. Again, most people don't understand how certain nuances on the report are going to impact the scores. If you have a number of accounts that are derogatory, they're negative, you had late payments in the past, maybe an account went into collections, you might need a credit building program before you're going to be able to pull the trigger on the financing. And that does take time. So you might have to open some new active positive accounts to offset the negative impact from the derogatory accounts. And that's usually it's going to take about 6 months to have, any significant impact in the scores by going through a credit building program. You can challenge the negative information. You have the right to ask for the credit bureaus and the original creditors to verify and validate the information. We talked about the first 2 score factors. The third one is credit history. Again, unfortunately, most people don't understand how credit history works. You have people out there financial planners are notorious. They will tell people, "Hey, Mike, listen, you have 6, 7 open accounts here. If I were you, I'd close most of them. Keep one open." That's like the worst thing.
That is.
That the average
old ones that you don't use anymore. You don't need it. Why do you need that? That's from 20 years ago. Well, there's a reason why you need it.
So keeping accounts open and active. Again, unfortunately, I didn't build this system, but this is what we're stuck with. So if you want, the highest credit score possible for you as an individual, you need to have at least 3 or 4 open active accounts. As a matter of fact, you wouldn't have a FICO score unless you have 2 open active accounts for a minimum of 6 months. So don't close any accounts. Don't open any new accounts. Don't co-sign for anything during this process.
The co-signer. Yeah, I don't want to talk over you when you say the co-signer part, because you know what? Let me come back to the co-signer part, because that's a big one. I feel, let's talk about the co-signer part now. I feel that people get this misconception that when you co-sign, it's like it's still the other person's liability, and you're just there, I don't know, as a helpful friend, but consumers don't realize, as a co-signer, you have the same responsibilities as the main signer. It's almost no different. So you're opening, you're signing for it, you're responsible. And it's not like lenders or creditors are taking into consideration some type of split. You're not like a 50% responsibility. You're 100%. You both are. Everyone is. If there's 4 co-signers, everyone's 100%. And it doesn't add up. It's only 100%. And that's how it is, right? Anything to add?
No, so again, we tell everybody, and I get it, parents are put under pressure to co-sign for their children, friends, family. It happens. But if it happens during the financing process, it can destroy the deal. You can lose the ability to complete the purchase, the refinance, any type of financing, just because you co-signed for somebody. So if you absolutely have to co-sign for somebody, because look, life happens. So there are going to be times where someone has to co-sign. And the idea here is that you need to be in control of that situation. So what I mean by that is you're either monitoring it in real time, setting up an online account for yourself to monitor that the signer, right, the primary borrower, is making the payments on time. Because if you don't do it that way, you might not find out until there's late payments, or even worse, they defaulted on the loan. This happens all the time for us. We have baby boomer parents that are looking to downsize. They're looking to sell their longtime family home, and they think they have perfect credit because they've never missed a late payment in their life. And when the lender pulls their credit, they have late payments, or they have student loans that went into collections.
So sometimes that's when they learn, right? Or it's like they got a letter. When you're getting letters, it's way too late. So if you're co-signing, you definitely need some type of monitoring, right? Because maybe it's not that big of a deal if you alert whoever it is 1 month, but start coming at them, month 4 or 5, and now you probably have financial problems on top of credit problems.
100%. So you're either, as a co-signer, you're either making the payment and the primary borrower is paying you, one way or the other. Like you said, Mike, you're responsible for the debt. So you're either going to find out very, very early or when it's too late, or again, set up your own online account so you can monitor to make sure the payments are being made on time. Remember, you have a 30-day grace period after the due date where it will not get reported to the credit bureaus yes, you're going to get stuck with a late payment fee, but it's not going to negatively impact your credit. So
Call them
again, credit history is important.
Like at least one waiver of those, as a grace on that late fee. But Paul, I had a question. Is there a caveat to closing accounts being good for your credit? So, for example, a lot of consumers will go into a store and it might be the month before they want to buy a home or a car, something large, and Victoria's Secret gives you a deal, 10% off. So you just open Victoria's Secret up just to get that offer. Now all of a sudden your credit profile you have 3 trade lines for a number of years, but now you have this one new one. Does it help that person to close Victoria's Secret when it was only a 1 month or 2 month, and it's really bringing down that average age of the trade lines?
It certainly could help that particular credit profile for sure. The worst case scenario there, Mike, would have been if they closed an account that they had for years prior, then they open up the Victoria's Secret account. Yeah. Now you've really skewed your credit history in the wrong direction. This happens all the time in real estate. I've heard it 1,000 times over the past 20 years. People put a contract in on a house. First thing they do is they run out and buy furniture. When they're checking out of Raymore Flanagan or wherever they're buying their furniture, they get hit with that point of sale marketing that says, hey, Mike, you want to save 20% today? Open up a card. Yeah. Opening up the new account means another new inquiry. Opening up a new account is scary to the FICO scoring model, and you've just damaged your overall credit history. So that's why my mantra is don't do anything except pay down your credit card balances. Don't open anything. Don't close anything. Keep your accounts open and active. That's the best way. Mike, credit history is 15% of your overall credit profile, right? 15% factor. So here's how you can have a negative impact on 45% of your overall scores. You close a credit card that you've had for a long time. You lose whatever available credit you had on that card. So you could be damaging your utilization ratio, which is 30% of the score factor. And opening up a new card and closing a card, you're damaging your credit history, which is 15%. That's a negative impact on 45% of the score factors without getting a late payment, a collection, short sale, foreclosure. Just by closing cards and opening up new cards, you could have a significant negative impact on your scores.
Yeah, that's wild that people don't really understand that, right? So just, simply you want an aged credit profile, right? You want a lot of history there. And the more history, the better, but at least have 3 long-standing credit cards. So that means that, start building it early and keep it open. And, the only thing I would add to that is every once in a while, you'll have a credit card that wants to close because they don't charge you fees and you don't use it. So, you might want to use some credit cards sometimes. And, it's not credit or financial advice necessarily, but I personally like having credit cards that give you some type of rewards, some cash back. And, when it financially makes sense, I'll use a credit card over any other means, over a debit card. You do have some financial protections and, with the rewards and all the benefits in terms of the necessity of having a credit profile. So certainly.
Yeah. You mentioned debit cards. People don't understand, even though it's a credit card, it is a debit card. They have no impact on your credit. So people, again, from a financial planning standpoint, that's great. I don't use credit, Paul. I have excellent credit. I never use my credit cards. I only use my debit card or cash. And I'm like, well, unfortunately, you might not even have a credit profile at this point. So keep them open and active. Buy your gas and groceries. Pay them off, every month. And just be careful about opening any new accounts or closing any new accounts in that time. And the last 2 factors are new accounts. Again, new accounts will typically lower the scores for the first up to 6 months. It's called seasoning the new account, because FICO is saying, why does Mike need access to another credit account? He doesn't have enough credit. He's using too much. So it's scary to the FICO scoring model anytime you open up a new account. And the last piece of the puzzle is the type of credit that you have. There's only two: revolving accounts or your credit cards, and installment contracts where you have a fixed monthly payment. Mortgages, car payments, student loans. These are powerful in terms of building your credit or wrecking your credit. So just be careful. But FICO likes to see a mixture of installment contracts and revolving. So again, fastest way from point A to point B, especially for a younger borrower. If you want the highest score possible for you as an individual at this, credit is a snapshot in real time, right? So if you want the highest score for you right now, you have to make sure you have both revolving accounts and installment contracts. If you need a credit builder loan, there's lots of companies out there that will provide you with a loan specifically to help you build your credit. We've partnered with a company called Self. They do a fantastic job with these credit builder loans. They take minimal interest rates and fees to cover their operations. And at the end of the term, you're going to get all of that credit history. It's the same thing. We're talking a lot about credit cards, but people a lot of times make the mistakes. Their cousin told them, hey, if you're going to go for a mortgage, you should pay off your car early. The bank would love to see that. Well, the bank might like to see it, but it'll hurt your FICO score. Because the score, remember what we said, number one factor is payment history. But that's on a monthly basis. That open, active, positive payment history every month is what's driving your score. Close the account, pay it off early. Sounds great, feels good, not good for your FICO score.
Paul, one thing I wanted to bring up, a lot of times when we think about credit, a lot of the consumers will it comes across as if they worry whether they qualify or not. And then, that's obviously most important, but then there's pricing that's attached to tierings. So, you just mentioned Self, great company and great service there, because building your credit, even if it costs money, you got to understand that you might be saving in the long run, or maybe saving a lot in the long run, right? So you might look at these interest rates on TV, on the internet, and those are always going to be advertised as tier 1 credit. You have that 800 credit score, that's you on the TV, right? If you have a much lower credit score, you're going to get a much higher interest rate. So, investing in just having as high of a credit score as possible might not only qualify you for whatever you want, but really save you money on paying lower interest rates. So,
again, Mike, I wish all lenders in the country, had your approach here, because you keep saying all the right things, right? So borrowers have to understand that it might, or it will definitely help you raise your credit scores. If you're going to buy a car, or your child is going to buy a car, and they have the cash to buy it, but what they should do is put 50% down and finance the other half, because that's how you build your credit. And people would say, well, but Paul, I'm going to pay interest on the financing. Yes, it's an investment. Trust me. Later on in life, when you go for your mortgage or other financing, insurance policies and premiums, security deposits, that's where you're going to get the return on that early investment. So it might cost you some money, right? To get a credit builder loan is actually going to cost you some money. By the way, it's also like a fixed savings plan. So you're not earning interest, but you're building your credit, which is going to definitely save you money in the future. So it's well worth every penny that you pay in interest. Credit builder loans or financing something that you wouldn't normally have to finance. But if you're looking to build your credit, there's not a lot of other ways to do it, right? Getting a secured card, you're literally borrowing your own money. So you don't want to carry a balance on a secured card. That's a little crazy. But getting a secured card, if you put $300 so that's how secured cards work. You take your hard-earned money, you deposit it into an FDIC bank insured bank account. That's whatever you deposit, that becomes your credit limit. So again, you're literally borrowing your own money, but it's looked at as like a traditional card. You can buy plane tickets, go on a cruise, buy whatever you want, like a traditional card, but you're building your credit.
Yeah.
And while we're on this topic, I will just put out one word of caution. There are companies out there or individuals that will try and sell you other people's credit history. This is bank fraud. This is actually a felony if you do it. It is very different than becoming an authorized user on someone that you know credit history. If you pay to be part of somebody else's credit history, you are committing a felony. And if you get caught, it's not a slap on the wrist. Now, the problem is there's loopholes.
This is out there. People are doing it. Huh?
It's out there all the time. Seasoned trade lines. The problem is there's loopholes that allow these companies to sell this information. And most of the time, they don't get in trouble. But you as the borrower will get in trouble. It is a felony. It is bank fraud. And, you'll probably go to prison.
That's that trap where companies know how to ask questions and then put the onus on you. You answer that question wrong, now you're the fraud. We just asked the question and we charge you money for it, right? I mean, that's got. I don't know this, but I mean that resembles that kind of scheme.
Yep. So you want to build your credit? Get a secured credit card. You want to build your credit? Become an authorized user. Allow your child to become an authorized user on your accounts. Get a credit builder loan. Those are the ways that you can help build your credit. Those are the only ways that you should build your credit. And it will take time. This is not an overnight fix. And that goes back to what you had said earlier. Knowing what your credit situation is as early on in the process is probably, one of the top messages here today.
So I spoke to a number of buyers today, actually, and that have concerns over their credit. Why don't we walk through, we have a buyer or you're a buyer on here, listening, you have concerns about your credit. What would be the steps now? All right, let's say you do want to buy a home, it could be anything, but let's talk about homes. What would you recommend? Should they go to a number of lenders? Should they come to me and I work through you? Like what is an ideal scenario?
So trusting the lender is paramount, right? As we all know, peer reviews, credibility all go a very, very long way. Not all lenders and loan officers are built the same. Some of them don't always have your best interest in mind. So know before you go, I guess, is probably the first message here. If you pull a credit report and there are issues that need to be dealt with, you have to do it as soon as possible. Again, there really are no quick fixes, overnight fixes. You're talking about at least a couple of months in order to change statuses, maybe have things deleted from the credit report, get an updated scores and improvements. It's going to take some time.
What does getting something removed from the credit report look like? I mean, you look at a credit report or profile and you say, hey, look, this is a collection on here.
Yep.
What does that sound like?
Well, I'll start with collections since you put the term out there. There are two different types of collections, charge-offs and collections. A charge-off is just a collection that the original creditor has not sold to a third-party debt buyer. Original creditors are exempt from the Fair Debt Collection Practices Act, the FDCPA. Third-party debt buyers are notorious. They prey upon us as consumers. So there was a law that was put into place called the Fair Debt Collection Practices Act. That's what protects us from these third-party collection companies. So they violate the FDCPA almost every day, and they know they're only going to get caught 8% of the time. They make millions of dollars, so they could not care less. Now, our clients go through a verification and validation of debt process. Believe it or not, paying a collection, right? So here's a big mistake real estate professionals and borrowers make all the time. You have a collection that's 3, 4, 5 years old, 6 years old, 7 years old, and you're getting ready to do some type of financing, and somebody might say, hey, Mike, you know, I looked at your report, and you're going to have to clean up those collections before we move forward. So people literally just go and pay them off. That paying off a collection that's over 2 years old will drop your scores. People say, Paul, no way. I go, yeah, way. I've been doing it for 20 years. I've seen it happen 1,000 times. Mm-hmm. So the way to approach collections, again, is called the verification and validation of debt process. And you want to be able to see if there's any violations under the FDCPA. Now, the average consumer or borrower might not be able to recognize violations. We have a partner law firm. It's like hiring an injury attorney. You don't pay for their representation. They'd be more than willing to do the verification and validation for free because they know they're going to spot some violations in their daily operations. They do it every single day. They find violations. You know, you have portfolio recovery, Midland Credit, Credit Collection Services, LVNV funding. These are the big debt buyers that are almost on every single credit report. So do a verification and validation of debt. If it comes back verified and validated, never pay the collection in full. The damage to your credit has already been done. You should be negotiating for, 50 cents on the dollar or less. The older the debt is, the better the settlement's going to be for sure. If time is of the essence and you have to settle it sooner than later, there's a sliding scale. But you have to be really careful with collections, for sure. Everything else on the credit report falls under the Fair Credit Reporting Act, right? Again, that protects us from the credit reporting industry. Mm-hmm. There are 3 different credit bureaus, TransUnion, Equifax, and Experian. They do a terrible job maintaining and updating our information. So don't just take the credit report for face value. There are different estimates out there from the Consumer Financial Protection Bureau, the FTC, the credit bureaus themselves, and they say, listen, we're monitoring about 240 million credit profiles. We're showing we have an error rate of about 12%. Mike, I know, 20 years later, 1 million credit reports, 97% of the clients that come through our doors have false, inaccurate, unverifiable information that's on that report. So what we do as a credit repair organization is we're challenging the future reporting of that derogatory information. If the credit bureaus and the original creditors wish to continue to report that information, we force them to obey the Fair Credit Reporting Act. There's a section called Section 609 that specifically deals with the future reporting of negative information. So you challenge it with the original creditor and you challenge it with the credit bureaus. And that's how 20 years later, we've been successful in forcing the bureaus. I don't delete the information, but we'll force the bureaus or the original creditors to delete it to the tune of over 100,000 deletions. I don't know what we're at now, wow. But it's a lot of information that's been deleted, and it should have been deleted. Nothing gets deleted unless it should be, right? So we don't have anyone that works at the credit bureaus. We don't have any magic beans or sauces. We're just really good at using the laws that are in place to protect you and I, all consumers, all borrowers. There are laws in place that protect us. We use them to our advantage, to our clients' advantage, successfully helping, again, thousands and thousands of borrowers over the past 20 years.
Yeah, no, I mean, that's great. And, we're at the hour here almost. So let me kind of just wrap it up, because what you just kind of talked about, just removing 100,000 of these, I mean, how many consumers were able to buy something that they couldn't, or at a better rate? I mean, probably saved hundreds of millions of dollars in interest when you really look along, and I personally have seen it from the buyers I work with. It's great to save people money, but it's also amazing to see a family buy their first home, or do something that they wanted to do that they weren't able to do, and we go through this process, they fix up their credit, and they're able to get in that home that they they really wanted. So there's options out there. There's a method to this, and you just have to go to the right people, I think, is the first starting point. So hopefully, if someone's watching this, they realize that we might be the right people, and we would love to help. So thank you so much, Paul. I really appreciate it.
Thank you, Mike.
For chatting with you, and obviously it's an easy topic for us, but for others, this might sound all very new. So we look forward to helping you. But thanks again, Paul.
Thank you, Mike.
All right, have a good one.
Ciao for now.
So that's just a taste of what we cover here, and in our full podcast, Paul Oster, the nation's credit repairman, and I go deep on credit secrets, common mistakes, and strategies that could save you thousands. If you want the full conversation and every tip, click the link and watch the complete episode now.